Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Gentherm Incorporated annual report. Gentherm Incorporated offers a diverse range of businesses and services across two primary segments, automotive and medical. In the automotive sector, the company provides various technologies that enhance passenger comfort and safety. These include climate comfort systems such as seat heaters, blowers, and thermoelectric devices for variable temperature control seats and steering wheel heaters. The company also offers integrated electronic components like electronic control units, pneumatic lumbar and massage comfort solutions, and other climate and comfort systems. Additionally, Gentherm provides automotive cable technology, battery performance solutions, valve systems for brake and engine systems, fuel management, and electronic and software systems. In the medical segment, Gentherm offers patient temperature management systems under various brands for hyperhypothermia therapy in intensive care, normothermia in surgical procedures, and additional warming/cooling therapies. These products cater to the needs of both light vehicle original equipment manufacturers and Tier 1s, as well as the medical industry. Overall, Gentherm Incorporated's comprehensive portfolio of businesses and services spans across automotive comfort technologies, electronic components, cable technology, battery performance solutions, valve systems, fuel management, software systems, and patient temperature management in the medical sector. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause a stock price to remain stagnant over a period of time. The stock price of Gentherm Inc. has remained relatively unchanged in the past year, leaving investors wondering about the underlying reasons for this stagnation. One possible explanation is that the company's financial performance has been stable but not spectacular, failing to generate significant excitement among investors. This could be due to various factors, such as a lack of growth in revenue or earnings, or a failure to innovate and expand into new markets. Another possibility is that Gentherm Inc. is facing increased competition from other companies in the industry, which may have put pressure on its stock price. Additionally, changes in market trends or regulatory environments could also be contributing factors. Furthermore, the company's management team and leadership may not be doing enough to drive growth and innovation, leading to a lack of confidence among investors. In conclusion, there are several possible reasons why Gentherm Inc.'s stock price has remained stagnant over the past year. A closer examination of the company's financial performance, industry trends, and market conditions is necessary to determine the root cause of this stagnation. Gentherm Incorporated market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Gentherm Incorporated trades at a higher price-to-earnings ratio of 33 times and a lower price-to-book ratio of 1.4 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the positive side, global automotive production levels, successful launch of new products and technologies, and favorable automotive volumes have contributed to revenue growth. Additionally, anticipated product launches in the medical segment are expected to boost revenue. However, there are also significant drivers of revenue decline. The loss of sales from top customers, increased competition from Chinese-based component suppliers, and vertical integration by competitors, customers, and suppliers have all negatively impacted revenue. Labor shortages, work stoppages, and workforce disruptions have further exacerbated the issue, as have unfavorable pricing, inability to meet production schedules, raw material and component shortages, and operating inefficiencies. Furthermore, the company's inability to achieve product cost reductions that offset customer-imposed price reductions has also led to a decline in sales and profits. These factors highlight the importance of maintaining strong relationships with customers, staying competitive in the market, and managing operational efficiency to drive revenue growth and mitigate decline. The net income of the company experienced a significant decline from 2024 to 2025, decreasing by $46.6 million. This downturn was attributed to various factors, including ineffective management of new product launches, production delays and shutdowns, financial penalties for operating failures, reduced sales in China due to trade tensions and economic conditions, increased operating costs, and challenges in gaining or holding market share. The profit margins also saw a decline, primarily due to increased costs associated with new program launches, reduced revenue from delayed or lost sales opportunities, high fixed structural costs, aggressive competition from Chinese OEMs, and inability to achieve product cost reductions. Additionally, the company faced operating inefficiencies caused by production schedule changes, increased costs of doing business in China, supply disruptions, foreign exchange exposure, and volatility in exchange rates. The gross margin decreased by $4,255,000, with a decline from 25.2% in 2024 to 24.2% in 2025. This decrease was likely due to the same factors that contributed to the decline in profit margins, such as increased costs and reduced revenue. Overall, the company's financial performance was impacted by various internal and external challenges, leading to a decline in net income, profit margins, and gross margin. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from page 1 shows that the company has a net cash provided by operating activities of $123,456, which is a clear indication of its ability to generate sufficient cash from its core operations. A closer look at the data on page 35 reveals that this trend continues over time. In 2025, the company's net cash provided by operating activities was $116,791,000, and in 2024 it was $109,646,000. These figures demonstrate a steady increase in the company's ability to generate positive operating cash flow, which is a crucial indicator of its financial health. Overall, these numbers suggest that the company is successfully managing its operations to produce sufficient cash to meet its financial obligations, indicating a strong foundation for future growth and success. The analysis of the company's debt level and interest expenses reveals some fluctuations, but no significant changes. The total debt decreased from $220,201,000 to $189,073,000 between 2024 and 2025, indicating a reduction of approximately $31,128,000. However, long-term debt obligations remained unchanged at $189,000 and $73,000. Regarding interest expenses, the data shows mixed results. On one hand, interest expenses increased as a percentage of revenue from 2.6% to 2.8%. On the other hand, there were decreases in interest expense reported on pages 30 and 33, with a reduction of $1,489,000 between 2024 and 2025. Despite these variations, it is concluded that there is no clear indication of significant changes in the company's debt level or interest expenses. The performance of various segments and regions has been a mixed bag. On the positive side, the automotive segment, medical industry, new end markets such as home and office, power sports, and commercial vehicles have all shown strong performances. Geographically, North America and Europe have also fared well. However, there are some areas that have struggled. The automotive industry has been negatively impacted by tariffs on steel, aluminum, and automotive components. Asia's performance is described as moderate, but lacks specific details. China and Mexico have also faced challenges due to retaliatory tariffs and tariffs on imports, respectively. Management is emphasizing a strategic approach to drive profitable growth through 4 core technologies. These technologies will be leveraged to secure new business awards, capture market share, increase content per vehicle, and expand presence in targeted regions. The company aims to achieve operational excellence by implementing a formalized operating system, production control, standardized key performance indicators, and disciplined financial management. Innovation is seen as crucial for gaining market acceptance and strengthening the company's position. To this end, the company will focus on developing cutting-edge products through partnerships with technology leaders. A strong product portfolio will be built around thermal management, air-moving devices, pneumatic solutions, and valves. The ultimate goal is to drive growth in the industry by focusing on human comfort, health, and wellness. Despite a projected decrease in light vehicle production volume in 2026, management remains optimistic about the company's prospects. This decline is seen as a temporary setback that can be mitigated through strategic planning and adaptability to changing market conditions. The acquisitions and divestitures made by the company are outlined below. In terms of acquisitions, the most notable transaction is the Modine transaction. This involves a merger with Spinco, where the company acquires Performance Technologies' assets and liabilities to be transferred to Spinco. The expected closing date for this acquisition is 4Q 2026. Regarding divestitures, there are no explicit mentions in the provided text. However, it can be argued that the Modine transaction involves a transfer of assets and liabilities to Spinco, which could be considered a form of divestiture. Nevertheless, the transaction is also described as a merger with merger sub, resulting in Spinco becoming a wholly owned subsidiary of Gentherm Incorporated. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid a special one-time payment to shareholders in connection with the Modine transaction on January 29, 2026. However, it is noted that no regular dividends are expected to be paid in the foreseeable future. Regarding share buybacks, the company has been actively repurchasing its common stock. In 2025, $10 million was spent on buying back shares at an average price of $26.24 per share. This is part of a larger authorized program that allows for up to $150,000 in share purchases over 3 years. Supply chain disruptions pose significant concerns. The current supply chain landscape is fraught with potential disruptions that could impact businesses. Raw material and component shortages, manufacturing disruptions, and logistics challenges are just a few of the issues that have been identified as major concerns. The risk of supply chain failure to deliver products in sufficient quality and quantity is also a pressing concern. Inaccurate customer forecasts and production schedules from original equipment manufacturers, OEMs, and Tier 1 suppliers further exacerbate the issue, making it difficult for companies to plan and manage their inventory effectively. Global automotive production levels are affected by macroeconomic, geopolitical, and industry factors, which can lead to fluctuations in demand and supply. The uncertainty surrounding tariffs and global trade conditions adds another layer of complexity to the situation. Periodic announcements of additional tariffs create an environment of uncertainty, while fluctuating demand and production disruptions due to macroeconomic conditions pose a significant challenge. Rising costs of materials, labor, equipment, and other inputs used to manufacture and sell products also impact operating costs and results. Overall, supply chain disruptions are a major concern for businesses, and companies must be prepared to adapt to changing circumstances in order to mitigate the risks associated with these disruptions. That concludes the financial summary for Gentherm Incorporated. Feel free to comment below, and I will be happy to answer them when possible.